Welcome to Talk Tickers. We break down complex earnings calls so you don't have to. Today, we're taking a deep dive into FNB Corporation. That's ticker FNB.
Yeah, specifically their third quarter 2025 results. They reported back on October 17th, and the market really seemed to like what it heard.
It definitely did. So our mission today, figure out why these results hit so well. The stock jumped, 3.0%, especially when, the whole regional bank sector felt pretty shaky just before.
Exactly. We need to get past just the headlines and look at the strategy, how management's using tech, and the guidance update. See what makes FNB maybe stand out a bit.
Okay, let's start right there then. Why the positive reaction? Well, the results look clean. FNB reported GAAP EPS earnings per share of $0.41.
Uh-huh. And that was a pretty comfortable beat over the consensus, which was hovering around $0.38. So you're looking at an 8 to 11% beat, depending on the exact estimate. Solid.
And crucially, this wasn't just like some one-off tax benefit or something driving EPS. It felt like it came from the core business.
Absolutely. It was very much a revenue story. Total revenue hit a record $457 million. That sailed past the street's expectation of roughly $448 million.
And year over year, that revenue growth was significant, around 11%.
Right. And what I found interesting was how the CEO framed it on the call. They didn't just list numbers.
No, they connected the dots.
Yeah. They basically said, look, record EPS and revenue happened because three things clicked: net interest income growth, margin expansion, and record non-interest income.
And this is the kicker. They did all that while keeping that efficiency ratio at 52%. They called it peer leading.
And, they're probably right to call it that. 52% is tight. It means for every dollar they bring in, only 52 cents goes out the door for expenses. That's really the core story here, I think.
It feels like they're turning what could just be short-term cost control into something more strategic, like a long-term shift in how they operate. Investors love that, especially now.
Definitely. Okay, so let's unpack those drivers a bit more. Let's get into the nitty-gritty, starting with core profit stuff.
All right. Net interest margin in FTE that expanded went up 6 basis points just from the previous quarter, landed at 3.25%.
That's a decent jump, especially when you see other banks kind of struggling with funding costs eating into their margins.
And that flows right down to what people call PPNR, pre-provision net revenue, kind of the cleanest look at core earnings power.
Exactly. And PPNR was up, get this, 11% sequentially, hit $213.9 million. That's real positive operating leverage right there. Revenue climbing much faster than costs.
And speaking of costs, even with that growth spurt, they kept their full-year expense guidance the same, still looking at $975 million to $985 million for non-interest expense.
They held the line, didn't let costs creep up with revenue.
Right, which signals discipline.
And it sounds like they're doubling down on that. Management talked about prepping a pretty significant expense initiative for 2026.
Oh, interesting. What does that involve? More than just cutting travel budgets, I hope.
Seems like it. They mentioned renegotiating vendor contracts, which can be chunky savings.
Yeah.
And really leaning into their AI and data science investments to find efficiencies. The goal is clearly to keep that positive operating leverage going.
Okay, so they're pushing hard on tech for cost savings, but I also saw they're planning a big branch expansion, like 30 new branches. How did those two things fit together? Seems kind of contradictory.
Yeah, it's a bit of a balancing act, isn't it? The idea, as I understood it, is to build these new branches smaller, more tech-heavy, in really high-growth areas like the Carolinas.
Okay.
And use the savings they get from AI and efficiencies elsewhere in the bank to basically fund that growth. So tech pays for expansion, theoretically.
That's the bet, anyway. We'll have to see if it plays out. But tech isn't just about cost, right? It's also driving the revenue side, particularly fees.
Absolutely. Non-interest income was a huge part of this quarter's beat. Hit a record, $98.2 million.
That really shows they're moving beyond just being a spread bank that relies on loan margins.
Diversification in action. Two areas really jumped out in the fee income numbers.
Let me guess. Capital markets.
You got it. Up 27% year over year. Huge jump. And mortgage banking was strong too, thanks to good loan sale volumes.
That capital markets number, 27%. Wow. Is that just market conditions, or is that their platform actually getting better?
Management argued it's structural. They pointed to expanding their investment banking capabilities, getting into public finance more, also scaling up things like hedging and treasury management services for clients.
Makes sense. And wealth management, usually a steady grower.
Yep, they mentioned that too.
Yep.
Historically, it's grown like 9–10% a year for them. It's a reliable engine.
They made a point about starting or expanding 10 different business lines over time that are now generating millions in revenue each.
Right, that's the proof point for diversification. It's not just talk. They've built these fee streams.
Okay, so fees are strong, efficiency is good. But the big question for any regional bank right now is funding, deposits. How did FNB manage that side so well when others are, frankly, struggling?
Yeah, good question. Well, their deposit growth was strong. Annualized linked quarter growth hit 7%. That's faster than the industry average.
And critically, those non-interest-bearing deposits, the free money, essentially held steady, still 26% of their total deposits.
Which is a great base to have. But here's the metric that really caught my eye. The cumulative total deposit beta.
Deposit beta, always important. What was it?
Only 24% at the end of the quarter. Since the rate cuts started, that is.
Okay, hold on. Let's translate that. 24% beta. Why is that such a big deal? What does it mean for them day to day?
It means they're incredibly well insulated against rising funding costs compared to peers. Think of it like this. For every dollar the Fed raised rates, FNB effectively only had to increase what they paid depositors by 24 cents.
While others might be paying 30, 40, even 50 cents on the dollar.
Exactly. They're managing deposit pricing really carefully and effectively. It's not just about chasing expensive hot money. They're using tech and smart strategies.
Like that common application they talked about.
Precisely. They said originations through that digital platform have almost tripled since they piloted it back in May. That's tech making it easier for customers and giving FNB better, cheaper ways to bring in deposits.
And it sounds like they incentivize their teams correctly, too, rewarding low-cost deposit gathering.
Yeah, aligning incentives is crucial. It's not just tech, it's strategy flowing all the way down to how people get paid.
Okay, so that discipline on the funding side, presumably that helps on the asset quality side, too. Less pressure to take on risky loans.
It certainly seems that way. Credit metrics look really solid. Annualized net charge-offs were low, just 0.22% year to date. And the allowance for credit losses, their cushion, held steady at 1.25%.
Any signs of stress simmering below the surface?
Actually, the opposite. Criticized loans, the ones they watch closely, actually decreased, dropped by $113 million, or about 7.3% just in the quarter.
Wow. So credit is moving in the right direction. What about CRE, commercial real estate? That's the big worry spot for regionals.
Right. And here FNB seems to be making a very deliberate move. They're actively de-risking their non-owner-occupied CRE exposure.
How actively?
They cut it by $226 million in Q3 alone. That's a significant reduction.
Okay, that is significant. Does that mean they're just walking away from potentially good business to appease the market? What's the trade-off?
Management would probably frame it as prioritizing stability and investor confidence. They brought that non-owner CRE concentration down to 214% of capital. Still high-ish, maybe, but the downward trend is what matters.
So they're shifting resources away from that kind of real estate.
And focusing more on traditional C&I lending, commercial and industrial, bread and butter banking.
And they made a point about not lending to certain types of firms, didn't they?
Yes, very explicitly. They stated they are not in the business of lending to private capital providers. That means no direct lending to private equity funds, private debt funds, that sort of thing.
Which, given all the headlines about banks' exposure to private credit blowing up, is probably quite reassuring to investors.
Instant credit comfort, exactly. They're sticking to their knitting, you could say.
So you put it all together. The discipline, the de-risking, the strong numbers. It makes sense why investors felt better. What about the outlook? Did the guidance reflect that confidence?
It sure did. Very constructive guidance. They actually raised the full-year net interest income forecast for the second quarter in a row, now expecting $1.39 billion to $1.405 billion.
And importantly, that new range already assumes a 25 basis point rate cut happens soon, which they penciled in for October.
Right. So they're guiding higher even with an expected rate cut baked in. That's strong.
And on the risk side, provisions for loan losses.
They tightened that up too, reduced the top end of the provision guidance range. Now $85 million to $95 million for the year, reflecting how good credit quality has been so far.
Okay, and all this feeds into capital. How are they looking there?
Record levels. Common Equity Tier 1 CET1 ratio hit 11.0%, a record for them. And tangible book value per share grew over 11% year over year to $11.48.
That gives them a lot of flexibility. Buybacks, dividends.
They did buy back some stock, about $12 million worth in Q3. Call it opportunistic and disciplined. But yeah, with capital this high and a dividend payout ratio under 30%, management basically confirmed that share buybacks and the dividend are very much active topics of discussion.
Translation. Expect more capital return.
That seems to be the signal, yes. They're operating from a position of real strength
Yeah.
and using it not just for buybacks, but also for that branch expansion we mentioned, 30 new branches by 2030, mostly in those high-growth Carolina and Mid-Atlantic areas.
Right. So overall, a strong beat, clear de-risking, tech paying off on deposits. It really did stand out, especially compared to some other regional bank news that week.
Definitely position them as a differentiator, at least for now. Which brings us inevitably to our next segment.
Ah, yes. Time for the part where we brainstorm an outrageous, yet maybe, just maybe, plausible trade idea based purely on what we heard in this call.
And let's be crystal clear.
This is absolutely not financial advice. We are not recommending you do this. This is a thought experiment. How might someone interpret this data into a trade? That's all.
Okay, disclaimer firmly in place. The trade idea is a classic relative value play. Go long FNB and short a peer, or maybe a basket of peers.
Okay. The rationale being,
Well, FNB stock got dragged down with the rest of the sector just before earnings, fell over 7% on October 16th. But these results, the 11% CET1, the 52% efficiency, the raised NII guide, suggest maybe it didn't deserve that pullback quite as much as some others.
so you're saying it might be mispriced relative to banks that are genuinely facing tougher funding situations or bigger CRE headaches.
Kind of like that, yeah. You're betting on the bank that seems to have more financial flexibility, less baggage right now.
So the mechanics. Buy FNB shares, hoping the strong fundamentals and capital return drive it higher.
And simultaneously, short shares of maybe a few regional banks known to have higher CRE exposure or tighter capital, or ones that are visibly struggling with deposit costs.
And the plausibility hinges on what? What makes this more than just a guess?
It hinges on capital deployment. The thesis is that FNB, with its record capital, is now positioned to launch a much more aggressive share buyback program, maybe as soon as Q4.
Ah, using that capital firepower.
Exactly. While the peers in your short basket might have to hoard capital because they're worried about potential loan losses or hitting regulatory minimums. So it's a bet on FNB's ability to actively return capital, driving its stock performance relative to those who can't. A bet on capital velocity.
Interesting thought experiment. Okay, let's wrap this up. Quick recap. Top 3 takeaways from FNB's quarter.
For me, 1, record core profitability, shown by that 11% PPNR growth and the raised NII guidance.
2, technology is clearly working for them, especially in driving that low-cost deposit growth and insulating them from funding pressures.
And 3, record capital levels combined with disciplined de-risking, particularly getting that CRE exposure down. That builds confidence.
Got it. And once again, folks, please remember this discussion was purely for informational purposes, distilling the earnings call content.
Okay, one final provocative thought for you to mull over. Management hinted they might accelerate cost savings targets for 2026, thanks to AI and those vendor talks.
Right.
So here's the question. If they actually manage to push that efficiency ratio below 52% while still pulling off that ambitious 30-branch expansion, does that signal a fundamental change in how regional banks can operate? Can tech-driven cost cuts truly fund aggressive growth like that?
Something to think about as you digest the details. That's all the time we have for this deep dive. Thanks for joining us on Talk Tickers.